Hello everybody and welcome back to the channel. Well, I think for the last couple of weeks we've been navigating this market pretty well. We've talked about the maximum pain down here. We've talked about the series of higher peaks and higher troughs that are currently placed in this market. But now we've come to a crossroads. We've got certain indicators that are telling us maybe the market shouldn't be going up anymore. And at the same time, we're still in an upward trend. So is this just more of a coiling market on the SP 500 and markets around the world getting ready for an explosive move to the next level? Or should we be concerned that the bear is about to come back? A lot of it lies on this little green box here. So let's talk about that green box and everything else right now as we cover stocks, cryptos, and commodities throughout the world. See you soon. Well, welcome back everybody to the channel where we talk about stocks, cryptos, and commodities daily. If you like any of those markets, always consider subscribing and smash that like button today as well, guys, if you enjoy our videos. This is for the market close the 6th of June 2022. And I think it's clear to see that fear still reigns supreme in the current market. No surprises there when we take a look at it. But let's look under the hood. Let's understand what's happening in the market itself. And on the surface, it may look like a flat day. Yeah, it was pretty much flat. There was only really a few stocks that were doing well. Amazon split, having a nice little percentage, and Google remained one of the strong stocks here with a 2.13% gain ahead of its split moving forward. Tesla also held up for the session, but not as well as you would have hoped. So what really was occurring? Well, we were in a market of two different gaps. We had a gap that was left from last week's inefficiency where basically the market was at a super high and then gapped all the way back down to a low. And then we saw the market rally back through to this point and effectively then move back after creating a new gap. That was the gap that was here. So the market opened up very, very bullish. And that was theoretically, it looked good on the surface. The problem was it left a whole bunch of price which it needed to fill. So what happened after that? It went back down to fill that zone and actually did a good job of doing so. It then hovered around the price, and at the time of this recording, the market's a little bit lower than this point, so we'll look at that later on in today's video. But realistically, it's just come back to fill in the zone, and it looks to be coiling in this current market. That is, the market is having a bit of a breather before making its next decision. Where I think the bigger interest lies is the sector rotation. We've made a special video about it in our previous videos, and you can definitely go and check that out. But basically, rotation is key to understanding whether the market is feeling bullish or bearish, and also whether it's feeling risk on or risk off. And it was another day of pretty good risk on. Basically, whenever we see TAN and PBW, that is clean energy, these sectors doing well, it tends to mean that IWM, that is the Russell 2000, and smaller cap companies are doing much better in these markets. And I think all of us would agree that in recent weeks, this has been the story. Let's take a look actually now at the last month of trade. And what you'll notice is the best performing sector is not what you might think. You might think, well, it's energy. Energy's done very well, but actually TAN, that is the solar index, has done 13.86%. Then comes energy, then comes utilities, and really strangely for a lot of you, then comes semiconductors. So yes, it has been risk on in this market over the last month, and we've been really following that using some of our lead indicators such as our XLY, XLP discretionary trade. So I thought it would be really great for us to have a quick discussion about some of these macro things going on right now and some of the key lead indicators that we've had in a while. And one of the things that's occurred here is big block trading. So we've basically seen quite a few big positions being placed back into this market. So it looks like insiders are purchasing. A block trade is basically, or a big block is an insider block purchase or sale is defined as the transaction more than 100,000 shares or 1 million. And you'll notice in general, it's been pretty good at picking key zones. Though that being said, there was a very bad one here in March 2008. So is that the same as this one here? Of course, they don't always get it right, but in general, they have a fairly decent strike rate of picking the key levels. Now, big block trades also came through in 2020, as you'll notice here, but it didn't quite hit the buy signal. So another strong reason to say that maybe we did bottom for at least now in these markets because, of course, the big block traders are with you. There are some ways of countering that, which we'll be taking a look at when we look at yields a little bit later. And one of those things is earnings and valuations. Have they come back down? Well, a lot of bond traders I've discussed with, and I've discussed this topic with, people that manage billions of dollars, they've said that their opinion is that we should get back into this level. And this is consistent with this chart. Basically, they're saying that we need to get back down to those levels of around 13 forward valuation on the PE ratio of the S&P 500. We're currently sitting at about 16.12. What do you guys think about that comment though? Do you think we're going back down to these levels here, these previous kind of zones, or do you think that this is the bottom right now? Let me know in the comments down below. It's always great to see what you guys think. We also have the McClellan oscillator, which basically is showing a strong buy signal at the moment. And we've talked about this in previous videos. Just thought I'd bring it up so you guys can see it. So on the surface, things look a little bit better, but let's get into the charts and talk about it. Firstly, the VIX. So the VIX didn't move too much. It basically sat around 25. This means that there wasn't really any extra fear, but there wasn't certainly any extra, need to push it down either. The volatility remained relatively high as the market filled both gaps. Being underneath though, the 25, I think is a fairly good sign, and it's possible now for the VIX to go back down to the 20 and then make its next decision. That's what we've seen quite a few times. Another down day here in the VIX, that could certainly be there. What about Dr. Copper? A lot of people look at copper as being a key metric in the markets, in the real economy, to show growth or weakness. And at this stage, copper is still sitting in the middle of the zone. So it's kind of pointing towards neither at this point. I'd call it neutralized, which is not necessarily a bad thing. Then we get into the more interesting components though, and that is the US dollar. So as you can see here, the dollar index, the DXY, or Dixie as many people call it, is going up quite a lot. And as it goes up here, it really looks towards basically money rotating out of the market and going back into cash. Remember, if the dollar index is strengthening a lot, that can be one of the things that we see occur. Now, it's not that we didn't expect this to happen. We've been talking about this box area for a little while. We obviously thought it changed all down here. And in the previous sessions, we did see the dollar index rally, and it's back at a resistance point right now. So will this be where it all changes? I tell you what, it's getting critical. And when we look at the S&P 500, you'll see why you really hope the dollar index turns anywhere between here and this area up here around that 103. Very important it does so. Let's now move over to another thing though, which is really yields. And everyone's talking about this again because all of a sudden, US 10-year has cracked 3%, and the US 2-year has really moved up quite a lot, 2.75. So as we know, the market is pretty susceptible to yields. If we think about the US 10-year, that's really constructed and created by the market itself, and it's showing that there's an increase. Now, we're not seeing inversion, which is, I guess, a good thing, but we're certainly not seeing this drop. We wanted the 10-year to drop. So I'm sure it'll come as no surprise to many out there that the 2-year and the 10-year are incredibly important. If I was to pick which one's most important, I'd always say the 10-year because that's really created by the market. But the 2-year and the 3-month are generally created by the Fed. That is, what is the Fed telling the market about the current rates moving forward? They're the ones that control the short rate. The market controls the long rate. And you can clearly see the correlation between each. If you think about the 2-year, when it was dropping, what occurred? The market was able to rally. Then it dropped even further off the cliff, of course, during the pandemic, and the market went haywire up. Then all of a sudden it starts to rise. What happens? The market doesn't initially like it, and it really needs to see real growth in the underlying stocks. That is, are the underlying stocks actually showing growth or not? And if you look at the current earnings and you look at the current growth statistics, the stocks like consumer discretionary, like Amazon, even Google and Apple, they're all up in the air for questioning, and that's why they're down so much. Whereas energy and also materials have done incredibly well, so those ones are clearly bringing across the S&P 500 for now. So a lot of the reason why we were able to rally at this point and even this point is a stabilization of the US 2-year. Effectively, if you think about it, the US 2-year stabilized and it allowed the rally to occur. The US 2-year stabilized and it allowed the rally to occur. The same thing happened on the 10-year. So is that going to continue to happen? That's a question that we must be looking at. And if the 2-year continues to go up and the 10-year continues to go up and the market goes up at the same time, it's never a good signal. So you don't really want that, and it can really show you false rallies, similar to what happened in the previous thing. But don't worry, we'll be following along with you guys out there. So remember to subscribe and smash that like button, because we will be following this story and of course continue to update you daily on this. Let's move over to gold. So what does gold not like? Well, it doesn't like 10-year going up. And at this stage, it's reacting negatively to that. Is gold still in a pretty decent little kind of level? Absolutely. Do we still have a general bullish tinge to gold for the time being? Yes, we do. But at this point, we have key supports around 1830, which was our previous level. And we've also got this chance that gold could even come back down to a demand zone down here at 1812. And both of those levels are still open for the potential of purchasing. Now, it all depends on the dollar index. If the dollar index turns around and starts to go down, what's going to happen with gold versus the US dollar? You're going to need to expect it to go up. But it's also a mixture of the 10-year and 2-year. So we want the 10-year to go down. If the US 10-year goes down, you'd be surprised of its effect on something like gold. Now, where the 10-year going up is good is oil. The correlation between high yield, 2-year, 10-year, and something like oil is very, very strong. So if you were someone that expected the 2-year and 10-year to continue to go up, then of course the correlation with oil is strong. A few weeks ago, we discussed the idea that maybe we saw peak inflation. And for many metrics, that's exactly what we were seeing on the charts. However, as we cautioned again last week, we didn't see the follow through from that. So unfortunately, that idea is shelved for now. And that's what a trader has to do. You have to know when you're right and when you're possibly going to be wrong. Now, if you went with your instincts and with the indicators and everything like that and traded the correlation, such as TLT or any of these other bond things, you would have been fine. But at this stage, there's no end in sight yet for US oil, yet for natural gas and things that are going with the correlation. If US 2-year and 10-year come back down though, be warned. These sectors do not perform well. And I remain relatively neutral here on US oil just because of where the price is. A lot of you disagree with me out there, and that's okay. Remember, you don't have to trade a particular instrument if you don't want to. Please remember that, everyone. We talked about it in our live stream, and we said, look, if you're not sure or you don't want to be in it, you don't have the confidence for that particular instrument at the time, just leave it. There's nothing wrong with that. But for anyone that's looking at the price action remains bullish here on US oil. And as long as 2-year and 10-year keep going up, you should be okay. XLY, XLP, this shows us risk on and risk off in the markets. Currently, we're still seeing risk on in general. The bonds indicator that I have is showing, I would say, stabilization, but no extra strength. So no extra signal from the bonds traders. They're kind of still weakening daily, but not by a considerable amount to be worried. But we do still have risk on, and there's still that upside potential to at least the 2.2 on this ratio. And that would hopefully allow us to get to some key points that we'll talk about on the SPY a little bit later. Let's move over to Tesla. Do we have an inverse head and shoulders leaning towards the bull side yet? Well, that's a good question. And certainly it does look like at this stage that could be very, very capable. Now, the one thing that didn't close gaps was Tesla. If we look at it on a smaller time frame, let's go to a 1 hour here, you'll notice there's a large gap that's now open and still available for traders to come back in and fill. Now, will they fill that? I think if the market starts to rally, there's a real potential here for Tesla. Remember, it is currently on a support. 700 is a big base for Tesla. We've seen it being bought plenty of times before. A close below 700, not good at all. Could that expose some serious lows for Tesla? Absolutely. So you'd really want to see it hold up in the next day of trade, ideally breach through here, and if it does so, fill that gap. It's already opened up hard, come back down, filled this, which was the gap initially, and found some decent strength into the end of the day considering the rest of the market. So a nice rally, fill the gap, and then if we breach through there, inverse head and shoulders on the way towards possibly even a big number. As we've mentioned before, if this inverse head and shoulders was to stay true, what would it do? Well, it would proof into the previous supply over here at about 950. So there could be some good stuff on Tesla moving forward. Be careful in a stock like this. I'm looking at it as a day trade and trade at the moment. So that is, not really looking towards too many strong positional holds, but that's only because the type of market environment we're in. Let's move over to Apple. What's going on there? Something very similar. Apple, potential inverse head and shoulders, obviously are pretty close to fill of the gap. And we're currently seeing this idea that if we breach through this zone, this 152, that we should be looking at a market that's going to start really showing that it's got the beans to go higher. And that's what we're all looking for, yeah? If we want the market to go up, it's going to need to do it pretty close to where it is right now. Let's check out the DAX. The DAX is still holding amazingly well. We mentioned this a few weeks ago. Inverse head and shoulders here on the DAX, breakout, very strong holding pattern, and actually doing better than the other markets around the world in many ways. Let's look at IWM. How's it going? Well, the Russell 2000, the small caps, they continue to just grind higher as best they can. We've talked about the pullback here and that being very equal to where it is right now. So it does make sense that the bears might try to attack this market. And yeah, look, I mean, we have to hope that that isn't the way. And unfortunately, hope is not really the best thing. It's done what we expected. If it goes the full distance like it did last time, that would push it into this supply here, which again proves fairly well. So we're getting near that territory where we need IWM to hold up, if not rally through. It already showed us that the market had bottomed back early in May. And that's why we've seen that outperformance of things like the solar index and of course, clean energy, because this, just like over here, rallied the first time and showed us the bottom of the SPY, the bottom of the Nasdaq early, and it also showed us the turn at the same point. So we will be watching the Russell 2000 incredibly closely over the next coming weeks. Let's have a look at the Nasdaq, how it's holding up. Well, it still manages to hold this 12,460. Now, unfortunately, the Nasdaq's left a gap that hasn't been filled, unlike the SPY, and that sits in this area here. So if I was looking, I think there's kind of like a zone in here which it's going to become very blurry between who the bears or the bulls are winning. And this will make more sense when we look at the SPY in just a few moments. But it does seem to be coiling. At the moment, the buyer demand is being held as best it can around that 12,450. And this becomes a very, very important zone for buyers to come in and show their commitment over the next 24 hours. At the time of this recording, we are literally pressuring that during the Asian into beginning of the European session. This is literally where the market is pressuring these orders. Does it coil? If it does, and we move back up and we breach, is that a very good sign? Absolutely. So many ticks. At that point, you've really shown that the market's considered this level, reset indicators, and it's ready to make that next move. So for the bears, they're looking for it to get back down, but unfortunately, all of this is going to be very, very tough to read over the next 24 hours. And we'll be doing our best job to, of course, follow that story and show you if it does happen. Here's the live markets on the SPY. So before we get to that, let's just quickly have a look here at the gaps and how they filled up, because gap fills are essential and also very necessary to see in the markets. So as you'll notice here, we had that huge gap that filled really or mostly filled at around this point, creating that coil. And we had a huge gap on the Monday between the open price and where it closed on Friday. So of course it had to come back and get this. It's done both of those nows. So where is the big key support? Well, the big key support is between this level here, which is the last low, 40.40, 40.50 area, and this 40.80. This little point here is where you want to see turnaround. So we want, if the market does come into here, you want to see that type of thing. That is, it creates a base structure, changes the direction of trend on the smaller time frames, and remains bullish. You do not want to see it through this area, because if it does do that, guess who's in control? The bears. And what do we expect then? Rallies and drops. So there's a lot at stake here over the next 24 hours, 48 hours of trade. And I think a lot of you will be keenly looking at this level. It's always what's scary, because those nuanced things, those very close to just slightly different things that are occurring, can really signal whether algorithms are coming in to dump the market or algorithms are coming in to hold it up. So be careful here. That's the zone, and certainly something we're looking at. Just to put it in effect, here is the futures market. So this is all of the trade together. And again, you'll notice how it structured up through that 40-40 zone, how it broke, and currently the defense that's going on here at the 40.70, 40.80. And you'll notice that it's trying to get under that first level. I wouldn't be surprised at all for it to come back down, test this area, and potentially then rally off it. That's where the buyers and the demand really needs to come in this green box. Could be a great day for day traders if they see the right signs. It's one of those ones that you certainly want to be looking at the open, paying attention, especially to the hour, retail hour of power, and then going from there. Let's move over to options. Why are we still remaining bullish? Well, firstly, the peaks and the troughs and the higher peaks and higher troughs are still in the trend of up on the smaller time frames. The other thing is we still have a lot of options sitting for the Friday expiration around 400. So the open interest is still pretty strong in the direction of puts. That is, there's a lot of puts sitting on that 400 SPY. If we look at the expiries coming into that though, let's have a look at the 6th of June, just where it's gone. Obviously a whole bunch of 430s expiring worthless, 400s expiring worthless. They've done a good job. And look at that 412. Get it back down to around that level. Don't pay them off. That's the idea of the street. Yeah, they're pretty nasty out there, that composite man. For the market moving forward though, notice where the next option expiration is. That's 380. So just down below, they've got it. So could it swing low and then swing up higher? Well, I hope not in this case, but certainly 400 still a big one here for the 8th of June. And once we go to the end of the week, you'll notice that if this does remain, the 400 still remains very, very strong here in these markets, with the 400 put being the biggest numbers. Let's move over to the crypto market. So another failure just below 32,000. We know that the buyers are really not committed towards Bitcoin until it holds above here. Sellers coming through, a mixture of yields really causing this, and just in general nasty whales manipulating the price. We're back to fair value in terms of the current volume profile, around that 30,000, 29.5. And we hope that this, of course, becomes a defended line. It's pretty negative in terms of the way it fell off here. So you'd want to see a bit of a change in terms of trend. However, it's back down to where the buyers should show some commitment between here and that low previously. A nice accumulation on Bitcoin, but it's really only accumulation if it breaks through. Otherwise, as many of you would know, it's really just distribution getting ready for the next move. So will crypto go into the crypto winter again? Remember, we're at a point now where we're basically about, I think it's about 700 or 800 days or something after the halving event. Once we get into that 900 to 1,000, we usually see crypto bottom around that point and then move back forward. Definitely subscribe because we will be covering that as well with you over the next coming weeks and months as that comes closer and closer through. So Bitcoin holding, the rest of the crypto market's not really that important until crypto turns, and that's Bitcoin turning. Let's now move over to just quickly remembering that we do have a Discord community, public Discord community, getting up there near 10,000 people. So thank you so much for joining us. If you're interested in joining our private Discord, you can do so. Links in the description down below. And of course, follow us over on Twitter at FXEvolution. Another thing that's occurring this week is a whole bunch of other central banks, the Australian Central Bank, monetary policy in Europe. And then, of course, we do have the CPI numbers coming through on Friday. That's at 8:30 a.m. New York time. So, of course, pay attention to that. But the market's going to do what the market feels like doing. At this stage, it still remains bullish, but we're getting to a demand zone. So let's see how the bulls and the bears fight it out at this level. Thanks so much for watching. Subscribe if you enjoyed the video. Comment down below on what you think the market's going to do next. And we'll see you in the next one. Bye for now.